And they are really the bulk of the key negotiable terms in a term sheet. However, there's a whole bunch of other terms. And when I was starting to do the research for the book the first time, I reached out to a friend of mine, Jack Tankersley, who was one of my mentors. He'd been a venture capitalist since the early 1980s. He was one of the founders of the venture capital industry in Colorado. And I reached out to Jack and said, hey, Jack, I've been doing term sheets for a while, and I know what's in my term sheets. I'd love to see some term sheets from like the 1980s and the early times before I started doing my first investments, which was in 1995. And I figured Jack would, dig out a couple of things and send them in. He sent me 2 big boxes full of bound documents of all the deal papers, not just the term sheet, but also all of the legal agreements for about 20 deals. And as I went through these term sheets, the first one I looked at, the second one I looked at, the third one I looked at, I'm like, nothing has changed in 30 years. Many of the other terms in the term sheet are an artifact of many years of venture financings. It's not that they're not important. They're sort of the boilerplate that all these documents have. But in a lot of cases, they're not worth the time to negotiate because they don't matter that much. And it's important to understand them. And if there's anything in there that's particularly important, especially in the context of your company, paying attention to it, but recognize that most of your negotiating effort should be put against the economics and control terms, because those are the ones that are going to really influence what happens with the company. One of the other terms that's in almost every term sheet is dividends. And there's one key word here to look for, and that's the word non-cumulative. Cumulative dividends, which are very common in private equity transactions, are very rare in venture capital transactions. What a cumulative dividend means is that every year that dividend applies, and if it's not paid out, it accumulates. And so it's essentially a way for the investor to get a return of a certain threshold year after year. It's effectively affecting the pricing of the deal based on that cumulative dividend. The vast majority of venture capital term sheets have non-cumulative dividends, and often the percentage dividend is modest, 5, 6, 7%. But really the key is that it be non-cumulative. So the worst thing that would happen is if the board and the investors determine to pay out a dividend, and usually it's if the board determines to pay out a dividend, it has to pay that dividend to everybody equally. The conditions precedent to financing generally are in every term sheet. They're usually very lightweight and irrelevant, and they're just saying, look, before we close this financing, here are some things that have to happen. It's important to know that the term sheet is non-binding. And reputationally, most investors who agree and sign a term sheet with a company follow through on that term sheet. Not all, and there are definitely deals that fall apart for various reasons. But generally speaking, the conditions precedent to close are just sort of the safety net for the investor who's saying to the entrepreneur, look, these things have to happen for us to close. There's a few to pay attention to, mostly so that you actually understand what's going on. The two that are probably the most interesting are, the first is any approval that that investor needs to get that they put in the conditions precedent to closing. Interestingly, in that, that usually signals that whoever issued the term sheet doesn't have final sign-off to do the deal. That happens in private equity all the time. In venture capital, it's usually agreed when you agree to the term sheet, but sometimes there's a separate investment committee, especially in later stage deals, that has to sign off on the deal. And so that, that line in that conditions precedent to financing, that there needs to be some kind of investment committee approval or other approval, is a signal that you've still got process to go through to get your deal done. The other one to pay attention to is anything that has to do with additional documentation from founders or employees that's not just confirmatory diligence. And what I mean by this is that most of the time in your first financing, you will have a number of agreements that are signed, proprietary inventions agreements, confidentiality agreements, things like that. In all future financings, there's usually confirmation of that. And if you've done a good job and have all those documents, there's no issue. But if you have not done a good job of that up to date, or you know that you have a founder that didn't sign something on their way out, or an employee that's confrontational, it's actually useful if you see that condition that there's something that needs to be signed again in that conditions precedent to the precedent to the financing. Pay attention to that and talk to it with your investor prior to signing the term sheet. Bring it up early in the process before you've done a bunch of work, just to make sure what you have to do. It's not something to be ashamed of or uncomfortable with, but it's not something you're going to be able to negotiate away. Information rights are in every financing. And the interesting thing here is that any significant investor will want a certain level of information rights. And this usually is financials, monthly, quarterly, annually, audited, whatever. And there's pretty boilerplate language for this. The important thing here is that there's often a threshold to define what a major investor is who gets this right. So you might have very small investors, small dollar amount or small percentage amount, that you don't want to share the financials with them every month. You don't want to have to provide the same level of information. So you can usually set a threshold. Fundamentally, my point of view is if somebody's invested in the company, even if they're a small investor, you want to be providing information to them, but you want to have control over what that information is, especially in situations where that person goes and works for a competitor, or their company gets acquired by a competitive company. Like you just want to have some ability to manage that. Generally not an issue with institutional investors and major investors, but could be an issue with small individual angel investors. So it's worth paying attention to, especially in those early financings. I really don't know why registration rights are still in financing agreements, especially early stage financing agreements. They generally take up plenty of space. They almost never really come into play. The time when they come into play is when a company goes public and after a company is public. And even in those situations, they're generally renegotiated anyway in the IPO process or eliminated in the IPO process. I would say, ironically, they're still in our term sheets. And I use them as a guide to whether or not the entrepreneur is paying attention to the right things. If I get involved in a heavy negotiation around registration rights, my first comment is generally to the founder, are you sure your lawyer has any idea what they're doing? Because most lawyers know it's not worth bothering with, and they're generally boilerplate. Right of first refusal or a pro rata right in terms of future investment is very common, is not something generally negotiated, and in a lot of ways is very advantageous to the company. It gives your existing investor the pro rata right, the right to invest in the next round that protects their ownership percentage of the company. If they have 8% of the company, they can have pro rata rights, so in the next financing, they still have 8% of the company. The only time where it's really worth paying deep attention to pro rata rights are in situations where somebody has super pro rata or a multiple of pro rata or a dollar amount that gives them above their ownership. So it's a case where somebody has, it's 5% ownership in a company post-financing, but she has pro rata right for 20% of the company in the next financing. The reason that some investors occasionally will want that is because they want to buy up more. They want to have the option to buy up more ownership in future financings. However, what it does is it gives them inappropriate leverage in that future financing because it inhibits a new investor from being able to invest and get enough into the new financing. There's nothing wrong with an investor who owns up 5% of the company buying up more ownership in the company and having 20% of the company. But you want her to be doing that proactively. You want her to be doing that before new investors are showing up with a term sheet. And when new investors show up with a term sheet and you're trying to fit your existing investors into whatever's remaining, there's always a negotiation around that, especially when the company is doing well. That's particularly true if this isn't defined clearly. So from my frame of reference, like liquidation preference, a clean deal would be a simple 1x liquidation preference, no participation, a simple pro rata right for the next round for your investors, totally reasonable, not controversial. Anything else, it's worth pushing back on. Voting rights generally don't have any impact on a venture deal because the actual rights are often just, again, boilerplate, but more importantly, the protective provisions are the really critical ones to pay attention to. There might be some edge case where the voting rights could come into play and could have some relevance. And so it's worth just making sure they're boilerplate and they're just a restatement of how the common and preferred interact with each other. But generally speaking, they don't really come into play. Another term which I put in the doesn't really matter term, but has become more important, especially as companies stay private longer, and as there's become a very, very active secondary market, especially in mid and later stage companies, where investors will buy stock from other investors or employees or founders. A ROFR, or right of first refusal, comes into play. And what this really means is that your existing cap table has the ability, when somebody is trying to buy shares that's not on the cap table from somebody on the cap table, or when somebody on the cap table is trying to buy shares from somebody else on the cap table, there's a hierarchy of right of first refusal for that deal. Now, that hierarchy tends to be the company first, sometimes the founders next, and then the major investors or the investors next. You'd have to go through this formal process where you start at the top. The company, okay, we've got a deal, you're buying the shares for this much. The company has a chance to buy them first, then the founders have a chance, then the other investors. Sometimes the investors and the founders are flipped. Today, the dynamics around this is you're constantly seeing, especially in success cases, lots of people trying to buy more shares from private companies before they go public. And it's a way both to control who owns the shares, but also in situations where there's mispricing of private shares for the company to either buy it and benefit all shareholders, or for one of the founders or one of the investors or a set of investors to buy shares when somebody else is selling. You'll always see in a term sheet a clause around proprietary inventions. These are basically documents where you want to have everybody that's working for the company assign their rights to whatever they do while they're at the company to the company. These are kind of a standard package of agreements that every founder and every employee should sign. Interestingly, in many financings, when you go through the diligence process, it's sort of the formal legal diligence, there's some of these missing. And it's good hygiene early to pay attention as a founder to make sure that you're getting these documents done and signed whenever you add a new employee to the company, whenever that first financing is done, whenever founders join the company. Good venture lawyers will make sure this is both documented and in place. But it's something that if you don't have a good venture lawyer at the very beginning is often not paid attention to. You'll see a co-sale agreement in many term sheets. It basically says that if a founder is selling their shares or another investor is selling their shares, that everybody gets a chance to essentially tag along with that to sell their ratable percentage. I would say, generally speaking, I personally don't negotiate much around this. I think it's better just not even to have the co-sale agreement in there than to be defining a bunch of boundaries about it. So when you find yourself in a situation where there's an opportunity to sell shares, the ROFR is the thing that's really applying versus everybody sort of like fighting and having to get consent and dealing with who does what to whom. Pragmatically, it plays some, but not that often. Almost all investors are going to want founders to be 100% focused on the business. This is going to be one of those clauses that you're going to see in almost every term sheet. And if you're not 100% involved in your business, having an open conversation with your potential new investors is critical. In some cases, it might be okay, but it's better to over-disclose than under-disclose. Another one of those terms that's in every deal is indemnification. The investors are going to want indemnification agreements with the company that basically puts liability on the company for things that are problematic that end up happening, not necessarily with regard to the investor's bad behavior, but with regard to the overall context of the deal. Again, generally not negotiable, and a good venture lawyer will always have the words right here, but it's pretty boilerplate. Almost all venture term sheets have a no-shop agreement in them. This no-shop generally is 30 to 45 days. The moment at which you sign the term sheet with an investor, you're basically saying, I'm committed to now getting this deal done with you. And that's what that no shop is for and what it applies to. Generally speaking, when a deal falls apart, the investor will let the entrepreneur out of the no shop. And again, that's a rare case because usually the deals close. Interestingly, though, the thing the investor is really trying to protect here, and it's important to the investor, is that they don't have a term sheet signed and then the entrepreneur is still running around looking for a new investor or a better price. So view the no shop as the binding characteristic of that term sheet that really is the thing that says, okay, we're going to go get this deal done now.
Number one, the investor has done thousands of these, and you've done one or two. You're at a disadvantage. So you think. The second thing that you need to understand is that this is just a game of people. There are just people at the table. And while you are thinking about the transaction and closing the round, what you have to remember is that there are egos at play. There are emotions at play. There is a lot more going on here than just the numbers.
For the entrepreneur, you want to understand what it is that you're negotiating, understand the terms, understand the things that are most important to you. That's critical. And you can get there by getting a good attorney, making sure that you anchor on the things that are most important to you, and then also the things that don't matter as much to you. So number one is understanding the deal. The second is you want to make sure that you achieve a fair result, that you get a good outcome from the negotiation. But the most important thing is that you understand that you are building a long-term relationship with this investor that you are negotiating with. Think about how you build great relationships. How is it that you have the most important relationships in your life? But my guess is the most important relationships that you have are built on things like trust and authenticity and openness and vulnerability and showing your real self, being your real self, not posturing, not doing the peacocking or other kinds of things that can happen in negotiating. It's about being your real authentic self. So this is not about how can I win this deal and how can I get the best possible outcome for me. This is the very first of many, many, many negotiations and conversations, and sometimes difficult conversations that you're going to have with your investor.
Fundraising is a stressful time in a founder's life, especially if this is the first or even second time you've done it. For you, managing your emotions through this process is key. The moment you falter in managing your emotions in front of me, I know I've got you. And I might not want to continue the relationship because I think if you're having a hard time negotiating with me now, how are you going to be able to grow this big business? So being aware of your emotions, learning how to breathe through it, learning how to not wear your emotions on your sleeves. Learning how to sometimes just admit that something didn't go well. One of the best negotiations I was ever in was when a conversation got heated because a founder got upset, and the founder walked away, and then an hour later called me and said, that did not go at all as I wanted it to go, and I am sorry, and I let my emotions get the better of me. Can we start over? And I thought that showed such incredible self-awareness on their part that I absolutely continued the conversation with them. By the way, that founder ended up being a phenomenal CEO, managed his team wonderfully well, and grew the business. It's just about the people. And when you can do certain basic things, you will likely have a successful outcome with your negotiations. So a couple ways to get to yes. First of all, make sure that I feel heard and that I feel understood. That means that you listen more than you talk. When you listen to what my actual concerns are, when you actually hear what I am worried about, you can address them or at least acknowledge them so that I know that you hear me. When you do that, you show empathy. And when you show empathy, I want to work with you. I'm much more willing to bend in areas that I might have been inflexible on before. There are a couple ways of making somebody feel heard. Number one is just using basic mirroring. Or I would just call it rephrasing. When I say something like 15 million pre-money valuation is my hard limit, what you probably need to hear in that isn't that 15 million pre-money is my hard limit, but rather I have ownership targets that I need to make. And if you understand that I have ownership targets that I need to hit for my partners, you might be able to come up with a more creative way of helping me hit those ownership targets. And it could be things around option pools, or it could be even things around warrants that allows me to achieve my objective. That's the difference between listening closely and just hearing the words that people are saying. So using a technique called mirroring, you can just say, I hear that valuation is a concern for you. In addition to mirroring, you can also use just rephrasing something or reflectively listening, which is saying, I hear that you want a 15 million pre-money valuation limit. Is it more accurate to say that you've got ownership targets that you're trying to hit and could be more flexible on the price? And when you do that, I feel heard and I feel understood, which makes me much more willing to bend on certain terms. Always have a next step. Every time you walk away from a conversation, you want to have a next step with me. You're always nudging me in a direction. So when you walk away from the meeting, say, so what are next steps? You'd like to go through our financials next? Or next steps might be, we should review the terms of the contract. Understanding what those next steps are help nudge me in a direction that gets me closer and closer to an outcome that you want. You've heard this before, but going into any negotiation, you want to be prepared. But what does that actually mean? So the very first thing is for you to sit with your co-founders and understand what your BATNA is. If you don't know what a BATNA is, it basically stands for the best alternative to a negotiated outcome. And what that really means is, what point do you walk away?
What is the next best alternative to you saying yes or no to this deal is critically important for you. And it may be that ultimately you want to walk away from the deal because it just doesn't meet the criteria that you have. But the first thing to recognize in determining if you're going to walk away is, what is your next best offer? What is your plan B or plan C? What is your BATNA?
Know what you will say no to and be prepared to say no. If you don't have the answers to those going into the negotiation, you will likely get pushed in a direction you are unsatisfied with later.
And I think what most experienced entrepreneurs that have raised lots of different rounds of financing will tell you is that there are very few terms that actually matter and that you want to dig your heels in on. And so understanding the things that are most important to you is really important.
The next thing you want to do to prepare is really understand the person that you're negotiating against. Understand what motivates them, understand where they are in their career, understand what excites them. You can find all this information out, often just by talking to them through the fundraising process up to that point, and also asking other founders or other entrepreneurs that have been in negotiations with them. The other thing that you want to understand is, what type of negotiator are they? Are they an analyst? The analyst is going to pick at every single little tiny thing. We all know them. You also have the bully, the person that just wants to win. You also have the really reasonable type. There are different types of personalities, and you're going to deal with them in different ways. The bully, you want to let them feel like they're winning. They need to always feel like they're winning. And as long as you can help them feel like they're winning, at the end of the day, you can still come out on top by having the couple, 1 or 2 points that are really important to you, but making it feel like it's their idea. The analyst, you just have to deal with them. You just have to go point by point with them. That's what they're going to do. They're going to nitpick you to death. But I've also found that analysts can be highly supportive of the business once they're bought in, because they will have looked in every single nook and cranny. They will have looked everywhere inside of the business and negotiated everything. So by the time they get to yes, they're going to be your best champions. Then you have the reasonable types. The reasonable types are the hardest ones, because if you're reasonable as well, you are likely going to be pushing on the same points. Understanding the different negotiating types will help you go into the negotiations in the most productive way.
In the negotiation, when you're dealing with you're working with your attorney, again, I want to very much emphasize that they are an extension of you in the negotiations. They're going to do a good job of representing you as a client, and they're going to come to you and say, here are the 10 things that matter, and I think you really could push here, and I think they're being unrealistic on this term, and you need to push back on this and this. And they're going to give you a whole checklist of things that you should really push back on, because if they were doing this, these are the things that they would push back on. Recognize that your attorney works for you, you don't work for your attorney. Ultimately, trust yourself, trust your own gut, and understanding that you're not building a short-term relationship here. You're building a long-term relationship. And the person that's going to help you build the company is the investor, not the attorney. Getting a good attorney is super important, but the person that's going to help you build the long-term viability of your company is the investor. And so you want to make sure that you're always thinking for alignment with them. And that might not always mean that you're going with all the things that your attorney wants you to push on.
your best position will be if you have multiple term sheets on the table. Sometimes the timing of all that can be pretty tricky, getting them to all come together at the same time. But when you do have multiple offers on the table at the same time, it can be very powerful in driving a better deal for you. You want to tell the investors that you have other offers on the table. You want to be honest about that, but don't tell them who, and don't tell them how much. And if they ask, they're trying to play you as well. You don't need to answer those questions. You can just tell them, come on. I know that if I tell you who it is, you're going to call them. But being playful about that. If you have multiple offers on the table and you end up going with one, not the other, the people that you said no to might come back for later rounds. You want to make sure you maintain great relations with the investors all the way through. Remember, it's a small community and investors talk. Maintaining healthy relations all the way through means do not play the zero-sum game. Do not play winner take all. It's about growing the pie for everyone involved. And if you can get there, it ends up being a very constructive process and will allow you to line up investors for future rounds as well. Entrepreneurship is about the long game. It is not about the battle. It's about the war. And the more that we come together and support each other through this process, even if it means we lose on this one little topic, if we win the war, we all win. Not just the investors, but also the founders and all of the employees that have stock options in that company and the community that those companies live in and the kids and the family members of the employees. Everybody wins. It's unfortunate to me when I see people playing the short game. But investing and venture deals is about the long game. Let's all play the long game.